In this presentation, we will take a look at an example problem related to the debt service fund and term bonds. Information is going to be recorded to a trial balance. The trial balance is going to have a beginning balance. We'll then enter the adjustments to the ending balance. We have the trial balance in order with regards to the assets being first in green, then the liabilities in orange, then the light blue being in the what would be equivalent to the equity section. In this case, the fund balance section, and then of course the dark blue and what would be equivalent to income statement accounts in a for-profit type of organization, temporary accounts, those that would close out to in a for-profit organization, the equity section here to the fund balance section. So the first item we have is we're going to record the budget in the debt service fund. The debt service fund is on a modified accrual. It's the governmental fund, and therefore we're going to record the budget related to it, something we typically would not do under a standard accrual system. We're going to say that we have estimated revenues on the temporary investments that we will have for the period of $9,000. Then we have the estimated transfer from the general fund. So we think we're going to get a transfer from the general fund of this amount. We're first going to record this as budgetary type of accounts. You'll recall that when we record the budgetary type of accounts, we might want to go through here and just basically list out which accounts are going to be, the budgetary type of accounts. So anything that says an estimate is going to be a budgetary type of account. So we have the estimated revenues here, and we say that we're going to get the 9,000 of revenues. So the estimated revenues we're going to put on the books at 9,000. We know that revenue has a credit balance, and therefore the estimated account is going to be the opposite, have a debit balance. So that'll go up in the debit balance direction. Then we have the estimated other financing sources. That also is an estimated account, a budgetary account, given the fact that it has estimate in it. The estimated other financing source we're going to have is the transfer from the general fund. So here's the transfer from the general fund. Again, it's going to be similar to a revenue account. So it's going to go, the revenue account would go up in a credit direction. Therefore, the budgetary account is going to go up in the debit direction. We're going to record that as a debit. Then on the expenditures side, or the expense-related expenditure side, we have appropriations. Doesn't sound exactly like an expenditure. We don't have estimated expenditures as might be expected, but we have appropriations. So appropriations, the expenditures, like expenses, have debit balances. The appropriation, then the budgetary account related to them, has the opposite, a credit balance. So if we record that out, then what we have is the appropriations, by the way, we're estimating to be 92,000. So that's the estimated expenditures. So if we record that out, then what we have is, as we record this transaction, a debit to the estimated other financing sources, a debit to the estimated revenue, those being the two revenue type items, the estimated expenditure, a credit to the appropriations, and then the difference, debits minus the credits, go into what, that's kind of like what we would think of as net income, right? That's going to be kind of like net income. It's going to have to go somewhere. We're going to stuff that into the budget, the equity equivalent type of section, the budgetary fund balance. And the fund balance, we're going to put it into budgetary fund balance. Then, if we were to record this out, as we will do, we have the estimated other financing sources. So that's going to be estimated other financing sources here going up in the debit direction. Then we have the estimated revenue. Here's the estimated revenue, it too going up in the debit direction. Then we have the appropriations, kind of like the estimated expenditures going up in the credit direction. And finally, the fund balance up here in the equity section, it going up in the credit direction. Next item, we're going to say that the general fund transfers to the debt service fund. So we're going to have a transfer from the general fund to the debt service fund. We here concentrating in on the debt service fund. So the money would be leaving the general fund, going into the debt service fund. Within the debt service fund, then cash, of course, increasing. We're going to increase the cash in the debt service fund. The other side going to what would be similar to like a revenue. It's going to act kind of like a revenue type of account, but we're going to put it into other financing sources. Recording this out, then we've got cash increasing. Cash goes up in the debit direction. The other side then going to other financing sources. Other financing sources going up in the credit direction, acting in a similar fashion as a revenue account would. Of course, in the general fund, we would see a mirror opposite of this activity. We would see a decrease in cash, and we have other financing uses as an interfund transfer out. And then, of course, the interfund transfer in here as we see. Next item, we have an investment. We're saying we're going to take that money, we're going to make a short-term investment. Now, recall that the debt service fund is designed to basically finance the debt. So the cash that we have, if we put it into an investment, it's basically going to be short-term. You'll also recall debt service fund is going to be on a modified accrual basis. Therefore, we're not going to have long-term assets in the debt service fund. So what we're going to do is if we put it into an investment, we're thinking short-term investment type of activity, earn some revenue as we basically hold on to any cash that we need that's going to be used in order to basically finance the debt that we have. So this is going to be a standard type of transaction. Then we're going to say, well, we have cash. We're going to take it out of cash, credit cash. We're going to put it into some type of investment. Some type of investment we expect to get some type of return on, such as interest or possibly dividends. So we're going to put it mostly interest. So we're going to debit the investments and we're going to credit cash. So that would be kind of what we would expect. Cash is going to go down. So we'll take it out of the one asset, cash. We'll put it into the other asset, that being the investment, increasing then the investment. Then we're going to say that we're going to pay interest on the bonds. So we're going to pay interest on the bonds. And if you look at the debt service fund, you might say, well, I don't see any bonds on the books. There's no bonds. There's no bond payable on the books. Why? Because this is a modified accrual basis. We don't have the actual bonds on the books. They'll be on the books with regards to the government-wide activity posted on an accrual basis. We're going to post basically the flow of the activity within the financing. So here we're going to be paying the interest. It's going to be basically cash going down and the expenditure being the debit. And the calculation we can see here is going to be the 4600000 times 0.04. That would be for a year. We're going to say they're semi-monthly or semi-yearly, and therefore we'll divide by 2, and that's going to be the 92,000. So again, we're not basically paying off, or we don't see the actual bond on the books. We're a modified accrual basis. We're going to record the expenditure related to the interest, and then the cash going down. If we record this out, then we have the expenditure down below. We've got the debit to the expenditure and the credit to then the cash up above. Next item, we're going to say that there's another transfer from the general fund. So we're going to transfer from the general fund. We're going to take that money. We're going to invest part of it into our investment as we did in the past. So we're going to say, all right, now there's another transfer. That means where cash is going up in the debt service fund because it was transferred from the general fund, and it would be, of course, going down in the general fund. And then the other side is going to go to the other financing sources, interfund transfer in. So then if we record this out, we're going to say, all right, cash is going up. We got more cash. Cash is going to be debited by the 512,102. We're going to credit the other financing sources, interfund transfer in. So we're going to increase that in the credit direction, it acting in a similar fashion as revenue, increasing basically the temporary accounts, increasing the equivalent of what you would think of basically net income type of account. And of course, if we think about the general fund, we would have the mirror opposite of this in that we would have cash going down. We would have debiting the other financing uses, interfund transfer out. So then we're going to go to the second piece where we have the making of the investment. We're going to do the same type of activity here. We're going to take the cash. We're going to take it out of cash. We're going to put some of it into the investment, short-term type of investment, because we are in the debt service fund, a modified accrual basis, doesn't have long-term investments in it. So we're going to debit the investment. We're going to credit the cash. Looks like this. We're going to say the investment's going to go up with a debit. So we'll debit the investment. The cash is going to go down with a credit, that leaving us with the 92,000, that being the interest payments. So it leaves us with just exactly what we need to pay off the interest payments. So then we have the interest earning. That means we're going to say that we're going to earn interest on the investment. So now we're saying the investment's going up in value because that's why we put it in the investment. We earning interest on it. So we're going to say the investment is increasing. So we're going to say investment goes up and investment has increased in value. And the other side is going to go to some type of revenue account. We're going to say investment earnings in this case. So we have revenue for the short-term investments that we put in place, earnings on it, possibly interest on the investments. If we record this out, then we're going to say that the investment's going to go up. Value of the investment went up by the earnings within it. And then we have the revenue from the investment earnings. That's going to go from 0, it's a revenue account, now increasing. So you'll note in the debt service fund, we don't really expect a whole lot of revenue from investments on it. Of course, most of our financing is probably going to be coming all the income type of activity that increases the credit balances on the temporary accounts, similar to revenue, might be from the other financing sources as they are here. In this case, we've got revenue, however, from the earnings of the short-term investments. Now we're going to take a look at the closing entries. So we'll go through the closing entry process. This is going to be similar as a for-profit accounting, but we're going to have to deal with the estimated accounts and the non kind of estimating accounts. So we have to deal with those added accounts that are estimating type of accounts. Bottom line, however, is that we need to close out the temporary accounts to what would be equivalent to the equity section, and here the fund balance. So everything below what would be equity, or here what would be the fund balance, all the dark blue accounts, we need to make them 0, close them out to their related what would be equity accounts in a for-profit, here related fund balance account. So we typically do that in a 2-step process. We're going to first kind of mark out the ones that are going to be the budgetary accounts, close them out, and then close the other type of accounts out. Also note, as you do this, we don't have typically the added kind of difficulty we may have in other fund balance accounts, that being encumbrances. We usually don't have to deal with encumbrances and encumbrances outstanding within the debt service fund, which is nice. However, we still have the estimated account. So let's close the estimating items up first. If we think through them, we're going to say which ones are estimates. Well, anything that has estimated in it. So we have estimated revenues. That's an estimated account. Let's close that out in the estimating journal entry. We have the estimated other financing sources. We'll close that out in the estimating journal entry. Then we have the appropriations. Those are going to be the estimating accounts on what would be kind of like the income statement or temporary account side of things. Then on the other side, we have the more of the equity type of account, or the budgetary fund balance, the fund balance type of account, asset minus liability type of account. And that's going to be this budgetary fund balance. Those should reverse exactly if we haven't made any modifications since the beginning of the year, the beginning of the period. It'll be an exact reversal of the budgetary journal entry we made at the start. So if we think about this, we're just going to say, all right, this has a debit in it, so we're going to make it go down. So we're going to credit the estimated revenues. Then the estimated other financing sources, it has a debit in it. We need to make it go to 0, so we're going to credit that one. Then we have the appropriations. It has a credit in it. We need to make it go down, so we're going to debit it. And then the difference between the debits and the credits is going to go to the budgetary fund balance. This is what we need. This is the plug entry to make us in balance. That then is going to go to the budgetary fund balance, which of course equals what's in it, because this is going to reverse itself exactly. So then if we reverse this out, then post this out, we're going to say that we have the 9,000. 9,000 is going down to 0. We're doing the estimated 9,000. And then we have the estimated other financing sources, and it's going to go down to 0. We have the appropriations, and it's going to go down to 0. And then we have the budgetary fund balance also going down to 0. Now you'll note that the estimated accounts are pretty much exactly what actually happened. And that's because they're term bonds. They're term bonds, so we know what's going to happen. We've already mapped it out. We know what the term bonds are going to do, what the payments are going to be, what the interest that's going to be owed. And if we have the same type of investment that we're putting in some type of investment with a fixed return, then we know that as well. So the budgetary information in that case should map out exactly to what actually happens, because there's not really any guessing game in terms of the terms of the bond. So in that case, it matches out, and it's not just a book problem that it matches out nicely. It should match out nicely if those are the conditions. And then we have this left over in terms of the actual accounts. We've got the revenues on the books as a credit, so we're going to remove that. We've got the other financing sources on the books, so we're going to debit it because it's a credit. And then we have the expenditures on the books as a debit, so we will credit that. We'll put the difference to then what would be equivalent to the retained earnings or capital account in a for-profit organization, here the fund balance account in the debt service fund. So we're going to say, okay, here's going to be the 9,000. It's a credit in the revenues. We will debit it to make it go down to 0 in the closing process. Here's the other financing sources. It's a credit in here, so we're going to reverse it to make it go down in the closing entry with a debit. And then we have the expenditures, which is a debit. We're going to do the opposite and credit it to make it go to 0. And then, of course, the difference going to the fund balance restricted. If we then post that out, we're going to debit the 9,000, making it go to 0. We've got the other financing sources. We debit it to make it go to 0. And the expenditures, which we'll credit to make it go down to 0. And then we've got the 941,204 that we're going to credit to the fund balance restricted. It's still being there. Now, of course, and we don't typically have a lot of activity in the debt service fund because we're tracking the debt service activity. So we're going to have the assets minus the liabilities equals the fund balance, which of course just includes the cash and the investments, adding up to equal the 941,204 in the fund balance.